Welcome to Market Call. I'm Morella Fernandez. Thanks very much for joining us today. Ryan Bushell on the show. He's the president and portfolio manager of Newhaven Asset Management. He'll take your questions today on Canadian dividend stocks. Here's how to reach us. 1-855-326-6266. If you want to call in, you can also email your questions. marketcall@bnnbloomberg.ca. Ryan, thanks for joining us.
Thanks for having me.
Thanks for coming in. Let's talk about the strength of the North American markets, reaching record highs yet again. What are they feeding off of?
You know, it's interesting. I have a lot of conversations with other professionals in the business and just generally with people, that know what we do. And there's not really a single person that goes, yep, this is how it should be. Most people are saying, I can't believe this.
What's going on?
This seems like a disconnect, et cetera, et cetera. But, on a longer term basis, if you look at the interest rate policy we've pursued since the financial crisis, it has destabilized the bond market to the benefit of the equity market. Mm-hmm. So you're seeing the equity markets benefit, valuations benefit. At the same time, too, we've got, an ongoing if you call it a bubble, you can call it a new paradigm as it relates to AI, however you want to describe it. But it's obviously feeding off of itself as well. So you've got a number of things happening kind of all at once. And for us, though, we just try to look through all of that and say, where are we today in relation to, a long period of history, and where are we going for a long period in the future? And we still like, the stable fundamentals of the companies we own. Okay,
so let's talk a little bit about unpacking sort of where we are, in the sense that I think everybody's had little hits along the way, and so there's not been a dramatic reaction since April to some of the news that's been going on. But we're now looking at the end of the year where consumers could begin to feel more of that tariff hit as retailers, for example, start passing through the cost that maybe they've been absorbing to date. Even that, do you think, like, investors will just work through because there won't be the kind of hit they had been expecting at the start of the year?
What's interesting about both April and then earlier in the year when the tariff news kind of first hit and there were some negative reactions was that it wasn't so much the general economy stocks that got hit, it was the technology sector. So I hesitate to say where the market's going to go based on the general economy. We even since the pandemic recovery, there's a lot of talk of the K-shaped recovery, right? The stock market's done this, and the general economy is kind of, fizzled to the downside as the stimulus has been removed. And so, we're not too concerned, I guess, with trying to figure out where we are in this cycle. I think it's very hard to say, and it's really, since, again, going back to the financial crisis, it's really driven by policy. So right now, policy is saying we're going to cut rates. The president of the United States is saying we're going to cut rates. And so the market is saying, we're going to push up valuations on the back of that. That has been the almost kind of Pavlovian response we've seen since 2009, 2010 on interest rate policy. So I think the general economy, some real-time data doesn't look very good. If you look at port landings, you look at freight traffic, you look at some of the results from the trucking companies, the FedExes, those types of companies, there's problems out there. And if you look at the tariffs as well, consumers aren't necessarily getting hit with them. Manufacturing, it's really the retailers and importers in the middle that are swallowing those for now. So as you say, those could start to get passed through, and that will hurt the consumer. Consumer discretionary is the worst performing sector in the S&P this year. So that shows you again where the limited impact is, but the market as a whole has been able to kind of power through that. So fall's typically a weaker period for equities. We're hoping to see some opportunities, but I'm not super optimistic either.
Got it. Okay, we're going to take a quick break. Ryan Bushell here, Newhaven Asset Management. He'll take your questions on Canadian dividend stocks. Here is how to reach us. We're back in just a moment. Stay tuned. Welcome back. We're going to start with an email right now from Parker. Parker says, is Propel Holdings a buy, sell, or hold? Please, Propel Holdings, online financials, credit service. I'm wondering, for this kind of business, which at the start of the year we thought would do so well, considering we thought the economy was going to come in a lot weaker, what's your forward look for this kind of company, Propel in general? moving forward?
Yeah, so there's kind of two stories. There's a long-term story here, which is the Canadian financial sector has been so consolidated for so long that it has left some openings for some of these more digital fintech type offerings in Canada, and we're quite behind the U.S. in terms of, like, if you look at Rocket or Quicken or some of the other big digital financials in the United States that have done quite well. So there's definitely a long-term story here. Short term or medium term, the question is, how is the Canadian credit situation evolving, right? And so we haven't seen, the boy who's crying wolf, but we haven't seen the Canadian credit story deteriorate yet. However, as those mortgage renewals come through, and you mentioned the impact of tariffs, which should be dampening on consumers across North America, more so in the US probably, but also in Canada. Just as it relates to tariffs, Canada has their own issues, productivity, other things that are hurting the consumer. But I'm curious on consumer credit. So I wouldn't be, we're very conservative investors. We prefer to have our exposure through the larger, more capitalized, larger dividend payers. But they're also the ones that are the incumbents, and companies like this take share. So we're not interested in that sector at present, and we'll be watching, think you might get a chance at a better entry point for something like that. But it probably is something we'll start to look at over time as these players become more established.
Got it. Okay, let's go to the phone lines. Brian is on the line from Victoria, BC. Hi, Brian.
Good morning. I'd like your opinion of Whitecap Resources with its 7% dividend. It's quite good that way. Or would you prefer something like Freehold Royalty, which I know you had as a previous top pick, and pays another percentage up to 10%, I think, for Freehold? Thanks very much.
Okay, thanks, Brian. So where are you landing on the energy sector these days? There's so much going on. Predictions now of the market sort of being flooded because of OPEC plus. We also don't know what's going to happen today when Trump and Putin meet, and whether that'll affect the sector. So where are you looking in energy? What's your thought?
Yeah, so again, we have a short-term story and a long-term story. So the long-term story for Western Canada, we believe, is a positive one. We finally have some infrastructure being built and some offtake being built. We finally have a government, it seems, and a population, it seems, that is more behind the
oil and energy
sector.
Yeah.
So that's a good thing on a long-term basis. But short-term, it's pretty cloudy, especially for oil. So I still like gas. I think the gas story is a big expansion of volume story just based on LNG Canada and the other smaller LNG projects set to come on in Canada, plus what's coming on in the US and the potential for that to draw some gas south as well. So I still like natural gas. On the oil side, you mentioned the OPEC returning supply to the market. That's gone better than I would have thought, actually.
Okay.
If you would have told me at the beginning of the year in a relatively sluggish demand picture that they would be able to add 2.5 million barrels and we'd still have an oil price above $60, I would have been surprised. But it speaks to some of the tightness that's going on behind the scenes. OPEC, not everybody can get up to that level. The people that were cheating before are still being punished. So they're not producing to their quotas. They're making up for lost time when they were overproducing. There's some puts and takes there. But I would say, as we head into the fall and the slower demand period for oil, I'd be a little bit more cautious on oil stocks generally, even though I do have one to talk about later in our top picks. And between Whitecap and Freehold, it's only about 1% higher on the yield. We like Freehold better. We just think it's a little more defensive, and you're not taking that capital investment risk in terms of developing the resources. Whitecap's a pretty powerful company now with the former Crescent Point now folded in. But I think it's going to take them a while to digest everything. And there still just isn't a great market for that mid-cap or now larger cap light oil, Canadian oil producer. It's not as exciting as shale in the States. The international investors are still have not warmed up to Canada on the energy side. So I think it's a bit of a tougher slug. So in both those companies, I think you're looking at your dividend. You're probably looking at some share price weakness over the next 3 to 6, 9 months. But over time, I think you get your dividend, and probably on a longer term basis, you'll do fine. So,
okay, so if you're happy with the dividend and holding on to it for a little while at least.
Yeah, exactly. But if you're looking to buy, I'd be waiting for a little bit better entry point.
Got it. Okay, let's go back to the phone lines. John on the line from London, Ontario. Hi, John.
Thanks, Marilla. Hello, Ryan. I'm a longtime holder of CIBC, and it's had its ups and downs, but generally I'm satisfied with the performance. 6 years ago, CIBC was in the midst of 14 consecutive quarters of missing earnings. Now, they managed their way out of that. What do you think of CIBC now? And if it's not in your top one or two, would you recommend another bank that I could dabble in? Thanks very much.
Okay, thank you for the question. We have CIBC up now. It's at 102. Over 3 years, it's up 64%.
Yeah, it's been a great performer. So we added this before the pandemic, actually, on the basis of, as the caller said, they had been kind of terminally underperforming. And we thought, with the new management team led by Victor Dodig coming in, that there would be some better performance out of the bank. And that has absolutely happened. They did a great job. Now Victor is retiring, I believe, relatively soon. And so the question will be, what does the next management team do? But I think there's pretty good momentum in CIBC. Again, short-term, long-term, I like that general path that they're on, and I think that the brand has been revived to some extent. It was in pretty bad shape, though. But now the question is, again, Canadian consumer, Canadian credit, mortgage renewals that are going to really start to ramp up at the end of this year and into next year. And so we're cautious on all the banks at these levels. There are some good arguments out there, from analysts that are saying, hey, these are still cheap based on this, this, and this. But just generally, when things get cloudy, typically you get some relief in the share prices. And then I think, again, I'd be waiting for a better entry point. I'm going to be saying that a lot today, probably, but especially so on the banks.
Got it. Okay, we're going to take a quick break. We're going to be back with more questions for Ryan in a moment. Stay tuned. Welcome back. Let's go to the phone lines. Chris has been holding on the line. He's in Victoria with a question. Hi, Chris.
Hi, Morella and Ryan. Thank you so much for taking my call. Ryan, I just want to say that I always look forward to you coming on the show. You are such a thorough investigator of companies. You don't just, provide words, but you provide specific details, metrics, and things that each company is up to in your answer. So I really appreciate that.
Thank you.
Absolutely. And I'm hoping to get your opinion on Premium Brand Holdings. I know that your colleague, who I also really admire, Rebecca, is a big fan of this company with their growth prospects that are coming to fruition with their facility in the U.S., big customers like Costco, the Dividend, the sort of a more visible way to play retail than some of the other mega beta names. And so I'm wondering what you think of this company for a 5-year hold at the current prices. Thank you.
Okay, thank you for the question. End of 2024, premium brands kind of sank for a while and hovered around there till maybe June, I guess, started moving up. Any indication of what happened in those months?
Yeah, so coming off of last year and the year before, actually, the big customer for them is Starbucks. They do a lot of the pre-made breakfast meals for Starbucks, breakfast sandwiches, things like that. So obviously with the struggle Starbucks had, people just took premium brands down alongside it. And then you had worries about tariffs, worries about Canadian companies that work in the U.S. and how's that all going to sort itself out. And so there was a general kind of malaise over those types of companies. So that's where Rebecca, I'll give her the credit. I certainly won't take the credit for it. She was strongly recommending it. And we started purchasing some in March. So that's gone well so far. So on a 5-year basis, we don't buy anything unless we think you can hold it for at least 5 years. We'd like to hold it forever. We really like the management team. The management team is up our alley in terms of here's what we're focused on. We're focused on a sustainably growing dividend over time, and we're going to build our business to support that, meaning we're not going to take too much risk all at once. We're going to steadily grow. There's a lot of things we think we can consolidate in the sector, so we like that, and they have a great track record of doing that as well. So we like the company. We'd like to buy some more. So generally, we're hoping for maybe some general weakness in the market, but they just reported their most recent earnings, and the stock popped pretty good. I think it was more than a 10% move off the back of that earnings release. So that's what's popped it lately. But in a positive market, tide goes back out. A lot of things can come off again. So we're hopeful to buy some more, but we like where we're at, and we like the company.
So you might dip in if it does come back down a little.
Yep, for sure.
All right, let's go to Dinesh, who's on the line from Burlington, Ontario. Hi, Dinesh.
Hello. Thank you for taking my call. My question is about Storage Vault. I've invested in the stock, and right now it's in the green with a return of 19%. I just want to know, should I hold, buy more, or sell? Thank you.
Can you tell me about Storage Vault?
Yeah, so this is a builder and operator of home storage properties, so residential storage, and I guess there's some probably small businesses as well that use these. This is an area that was really, really hot a couple of years ago. You had
they were popping up everywhere.
Well, the real estate market, went from residential and office to and some retail to then the pandemic switching over to e-commerce. So then industrial was really hot in terms of warehouses, and then storage became hot as well as people were changing house. There was a lot of moving of houses, things of that nature. To me, the problem with both the industrial and the storage sector being a smaller part of the industrial market is just that there isn't a ton of barriers to entry, right? You can put these things up. They're relatively cheap to build. There's a huge one going up right near my like close by home in a site that I would have never thought would have been home storage. So to me, again, that supply demand can change rapidly, right? You can add a lot of supply in a relatively short amount of time, and there's not a lot of differentiation on like a box is a box, right? So it's not a sector I'm really super positive on. I know that there's some great stats that support, this is a growing area. People have more stuff. They need places to put it. If it's close by, they'll do it, and they'll keep their stuff versus getting rid of it and pay the rental fee. But just not a sector that has a strong enough fundamental defensibility about it that it can go through all different kinds of cycles that we just we're not into like a short-term 2 or 3 year trend.
It always makes me wonder what kind of stuff are people putting in these storage boxes for units for years, but who knows? All right, so let's go to
economy.
Stuff and stuff. Justin is on the line. He's in Calgary. Hi, Justin.
Yes, good morning. I'm currently in West Shore Terminals, and I've been in it for a while. Been quite happy with it, and I'm thinking about buying quite a bit more. Just interested in some analysis, I guess, on the long-term prospects. Thank you.
Okay, thank you for the question. West Shore Terminals.
Yeah, so there's a lot of uncertainty in this space now with the proposed rail mergers in the United States. And so CN for a long time has had a good position in that they were able to kind of come across the continent and bring goods in and then take them down to the US versus if you think about the proposed merger between Union Pacific and
I can't remember.
CSX, I think maybe it is. I can't remember exactly. But the two railways, basically, they come to the mid-continent and then they have to transload, meaning they have to take it off one company's trains and put it on another company's trains, which makes it slower. So there's some question around West Shore, whether that's going to hurt them or not if volumes start to be diverted to other ports. So I don't really have an intelligent answer on that. My guess is it will probably be fine. The stock is, been, as you can see there, it's been kind of bouncing within a range. It pays a decent dividend. And so it'd probably be okay, but I would ahead of sort of getting some more certainty on where that's going, I would be waiting and seeing.
Norfolk Southern was the other one.
Right,
Yeah.
yes.
Okay.
CSX might go to BNSF.
We're going to take a quick break. We're going to be back with more phone calls and emails, and also Ryan's past picks. Back in a moment. Welcome back. It is time now to go through Ryan's past picks. These are from the end of July 29th of 2024. First pick at the time was Pembina Pipelines on the TSX. It was 52.72. It dropped now to 50.52, so 4% return drop, but a 1% total return upside. Can you just expand on what's been going on with Pembina?
It's surprising. So bonus pick for today. If I was allowed to pick it again, I would. I think they're really well positioned. The stock ran into the low 60s, or maybe just right around $60 last October, November, and has since come off. You can see it there. Got up just above 60 there in November and December. And I'm surprised as to why. Now, there was a recontracting of the tolls on the Alliance pipeline that they bought from Enbridge. That went a little bit worse than expected. Okay, I can see that. But if you look at the growth in production of natural gas in the Western Canada that's occurring now and is set to occur over the next sort of 5 years, including their own liquefied natural gas project in concert with First Nations community, I think they're extremely well positioned for the growth out there. So for us, we're continuing to buy it as much as we can for anywhere we need it, and happy to collect the dividend in the meantime.
Got it. Okay, let's get to your next past pick, which is ARC Resources, kind of in the same space on the TSX at 23.20. At the time you recommended it a year ago now, up to 26.98, almost at 27. So 16% upside and 19% total return. Also, many say well-positioned to uptake for the gas and the continued sort of international shipping of the product to markets that want it.
Yep. So couldn't agree more. Obviously, it was up over 30 there in June, and then there's just been some weakness in the gas price over the summer, and obviously some concern. They have a fair amount of their production is tied to oil prices as well on the condensate side. So yeah, it's just kind of settled in there around 27. We are stepping in at that level for clients that either don't own it or need to own some more of it. Happy to own it at these levels. Think it's a great, well-managed company for the long term going forward. So,
is there a lot of growth for them if the markets do increase?
Yeah, they have a lot of organic growth. Actually, they did just buy some land and then some assets too that were on the block. I think they were out of Strathcona, and so they rarely acquire, but they did acquire some production, and just they've got a great land position. They can continue to develop, but they'll do it slowly. They'll do it methodically, and that's what we like out of them as a management team.
Got it. Okay, let's go to your last pick, K-Bro Linen, which was recommended at 36.59, now is 38.40, so 5% return and 9% total return. This company I find interesting. So they did an acquisition. I know they're in the UK, I believe, and they basically do sort of linens, hospital linens, hotel linens. The acquisition they did, what was that?
So it was a linen company in the UK and geared more towards hospitals. So we actually just spoke with the management team this morning. This company is a sleepy company. They don't do a ton of marketing. They're not covered by a lot of analysts, and they don't do a lot of banking. They're very frugal and well managed, and they only come to the market when they need to. They did this spring for this acquisition that they think is transformative for them. They were up against a large UK public company in this acquisition process, and the seller decided to go with K-Bro, and that would have been a bit of a surprise. They were the underdog in that process, or at least that's the way they viewed it, which I thought was interesting. But they think that they're very confident they can get the synergies out of it. They do hospital as well. This other company, it would have been an add-on for them, so a diversifier for them because they don't do hospital, but with the relationships they already have with the NHS, the National Health Service in the UK, they think they can do quite well with it. And this is a management team we really like. They keep their heads down. They're not promotional. It's a stock that is probably somewhat undervalued because of that, but we like it because we're trying to own it on a long-term basis, and we got new clients coming in every month, a ton of them this month, where we need to buy more. So we're happy to buy them, but the stock did pop in the last couple of days.
Yeah, what was that pop from?
So they released earnings yesterday, or either yesterday morning or the night before, and it was just a reaction to, the early signs on the acquisition and just general. They've been running a great business. Their business has been. They had some issues following the pandemic with staffing, and natural gas prices went crazy in the UK, and there was a few kind of transient things that they had to work through. But since that time, the results have been quite good. So we're happy with that.
Got it. Okay, we are going to take a quick break then. Ryan Bushell sticking around to answer your calls about Canadian dividend stocks. Back in a moment. Welcome back. We are going right to the phones. Ross is on the line from Windsor, Ontario. Hi, Ross.
Hi, thanks for taking my call. I'm a long-term holder of Waste Connections. Over the last year or so, it's been sort of stagnant, and I've been thinking about putting some of it to the curb. I was wondering your guest's opinion on that. Thank you.
Waste Connection. We'll pull up the chart.
Pun intended.
Pun intended, exactly.
Yeah, so the waste sector has had a tremendous run over the past, let's just say, decade in terms of the public companies involved in that space. We've had a lot of economic uncertainty, and not that anything has really played out super negatively. Like, we haven't had a massive recession or anything on par with 08, 09 or anything like that. But it has driven investors towards some of these kind of quote unquote bulletproof names that, garbage is getting picked up. And we benefit from that across our portfolio, the utilities, the infrastructure companies as well. The thing about those is that the regulation of those doesn't allow for what's been happening in this sector, which is the roll-up story of rolling up all of these smaller waste providers and then getting benefits there. So I think it's just kind of exhausted itself. I think the whole sector kind of has, right, in terms of the multiple, like there's just only so far these things can go. So I don't mind, we don't own any. We would like to be an owner of these businesses, potentially on a pullback, but we'll probably need a larger macro-based pullback to get that. If in the caller's view or in anyone else's view that's been right on the sector for a long time and seen, kind of more than a double and seen the weighting in their portfolio increase, I don't mind trimming some and putting it back to work elsewhere. I'd have to see the portfolio and tell you, where you're light and where I think you could add some value with the proceeds. But portfolio rebalancing is healthy, and it's not, you need to let your winners win. You don't want to do too much tinkering. But when you've had a big long-term secular run like that and you've got overweight position, trimming 1 or 2% off of it and putting it elsewhere is probably a healthy thing for your portfolio.
Got it. Okay, let's go back to the phones. Mark on the line. He's in Port Elgin. Hi, Mark.
Hi, how are you today?
Good, thank you.
Yes, I'm just phoning to ask Ryan about basically about the Canadian energy sector. Given the fact that it seems like we're going to go into some sort of apparent global slowdown, that it might be time to look for another sector, maybe rework my portfolio. And in particular, I'm asking about CNQ.
Okay. So energy space we touched on a little bit before. You like natural gas sort of moving forward. And he's looking specifically at CNQ. But can you give me sort of where we are, where you see the most growth happening? I imagine it to be natural gas, but also touch on oil, because a lot of people have that in their portfolio and it's kind of flatlined.
Yeah, and again, that's where you want to have some income. So whether it's a CNQ or a Suncor, and I, if we talk about IMO or Sonova, like there's kind of actually a nice spectrum of different companies with lower yields, higher yields, more growth, less growth. And so for us, we want to have a core position there, and we want to have a mixture. We've tilted more towards natural gas than oil because the fundamentals for us for natural gas in Canada look pretty good relative to the oil fundamentals, which are stable to, depending on what happens with Iran or Russia or, even Brazil, a lot of production potentially to come on there. Venezuela is another one. Oil is going to be, what we think is relatively a sideways market barring some sort of crisis or unforeseen event. So we want to have the income. We still think the Canadian, both the oil and the natural gas story is a positive one. Especially, if you look at oil sands or even the light oil that's produced in Canada, it's competitive, it's low cost, especially with a 70 cent or below Canadian dollar. It makes us more competitive as well. And you also have the prospect of, we've got 8 to 12 million barrels a day of U.S. shale production that may or may not last at that level in terms of both the capital that needs to go in every year to get that production out, and just the quality of the reservoirs, and just are they exhausting more tier 1 inventory. We don't know that yet, but there are some signs that point to that. So I don't think you want to divest. I think you might need to hunker down in a few core names, and we'll talk about CNQ a little later to spoil a top pick. But I think that's one you can stick with, and we're adding to it at these levels.
Got it. Okay, let's go to Dominic on the line in Montreal with a question, an insurance question, I think. Hi, Dominic.
Yes, hello. Thanks for taking my call. Ryan, I'm looking at Intact Financial and expecting a little bit of a pullback in the general market. The industry of insurance seems quite good. Intact Financial, well, quite defensive anyway. Intact Financial has dropped since June almost 12%. the price earnings is about 15 or so, which seems fair for this kind of company. I'm wondering on getting your insights on valuation. If there is a pullback on this in the market, do you see any a value on Intact Financial since it's already dropped about 12%? Do you see any growth from here? And do you own it? Thanks, Ryan.
Okay, so I'm just going to say it was 316.65 end of June, so not that long ago, and we've seen that drop since then. What's going on?
So similar to Waste Connections, right? This was a really well-loved company, and I don't get everything right. And I remember I met with them. This is before I joined Newhaven, so this is going back 8 years now. And I remember meeting with them and being very impressed and going back and thinking about it and humming and hawing and going, well, one thing that worried me about the space generally was just the unpredictability of what they call catastrophic losses from things like storms and unforeseen weather events and just were these companies properly insuring people? Were they ready for that risk? And ultimately decided to pass. It's our conservative nature to really look for things that are super sustainable. But Intact has done great. It's been really well managed. Those risks have not. They've been able to manage through those. And then you had this big inflationary environment post pandemic that helped them as well with big price increases as the price of building materials and replacement costs for insurable products went up. So did the premiums, right? And so there was a nice run there. Now I think what you're seeing. I think the results, most recent results, which is where the drop happened, were fine, but I think it's just kind of, again, another one that's maybe just exhausted itself for now, and we'll have to kind of either grow into that multiple, or as the caller mentioned, if we were to get a pullback, if we were to get a market pullback, it would depend. It would depend on whether people are really scared and are selling winners because that's the only thing they can sell with liquidity. In which case, the Intacts, the Waste Connections, the Dollaramas, some of these higher valued stocks might be in for more of a drop, or if it's just sort of more of a temporary fear thing, like early April, and people just trim, other things, and those stocks hold up well. So I don't really know, but if it were to pull back materially, given the quality of the business, it's certainly one we would look at.
Because it's already dropped since the end of June till now, as you mentioned, probably 12%, would you hold on to it at this point and sort of hope for a ride back up? What would you do?
If we owned it already, you mean?
Yes.
Yeah, I think, again, it depends on everybody's situation. Again, this is another one, I think, where if it's done incredibly well in your portfolio, I think there are a few candidates, and we'll talk about them in top picks, where you might want to rebalance some funds, some things that are a bit unloved right now. There isn't that many of them, but there are a few. And portfolio rebalancing is always healthy. But yeah, I wouldn't let the recent weakness, it's probably more likely to close that gap back up than to decline further, unless something unforeseen happens, either on a macro basis or micro with the company. But my guess is that people will migrate back to this name because it's pretty high quality.
Got it. Okay, we are going to take a quick break. We're back with Ryan in just a moment. Your questions today on Canadian dividend stocks. Stay tuned. Welcome back. Ivan's on the line. He's in Milton, Ontario, with a question today for Ryan. Hi, Ivan.
Hello. Thanks for having me on here, Ryan. Thanks for sharing your knowledge of the industry. Question is for on South Bow, SOBO, Canadian or U.S. It seems to be slowly, steadily climbing with a 7-point plus dividends, rather high but good. What do you see for the future in them? Are they going in the right direction? Are they strong? They seem to be going that way. And I know they had left. They were partnered with a company in the past. Is there any feedback for the future on them? Thanks.
Okay, Southwell.
Yeah, so it's been interesting, the whole space. So whether you look at everything except Pembina, actually. So TC, Enbridge, they've all been really grinding higher. Fortis is another one. And so this is a big part of our investment thesis, right, is that we believe that these infrastructure companies, there's going to be opportunities for them, and as power demand and energy demand in North America continues to be robust, that these companies were undervalued at the prices they were at, and should be higher, especially if you look at the broader markets and where everything else is trading. And then that is sort of coming to pass. on the back of that too, we've also got a rate cut story happening. And I'm a little bit more, if you look at RBC, which they're kind of an outlier, they're calling for no cut in September. And I think if we don't get a cut in September, I think you might see the markets generally have a bit of a tantrum. This has happened before. And some of these interest rate sensitive names that are maybe running on the basis that interest rate cuts is going to make them more attractive, you might see a bit of a pullback. So I think there's some short-term dynamics there. And I just wanted to kind of illustrate that for the viewers. On South Bowl, generally, I mean, it's a cleanup story, right? So it's TC couldn't sell the Keystone system as an asset sale because of the leak they had right at the beginning of, not this year, but the year before. So they did a spinoff. Initially, it was not well received. Maybe it was 2 years ago. Anyways, the spinoff was not well received initially, and then lo and behold, by the time it came around, the market had gotten behind it, and South Bowl, we thought maybe it might trade down as a smaller stub, and it really never has. It's been a little bit volatile, but it's been relatively strong since the spin. So I like it going forward. The question is, do they ultimately find a buyer, and does someone ultimately take it out, and at what price? And so I think if you're holding it, you're collecting 7, and that's your upside. Your downside is they have more problems with the pipeline that has had a lot of problems over its history. And so when they did the spin, we just kept it. So we kept our TC and we kept our South Bowl. We were happy to have them in those proportions. We didn't add to it to have overweight exposure to it because we didn't want undue exposure to that singular asset. So that's what we did, and we're happy to hold it here and see what happens.
Got it. Okay, let's go back to the phone lines. Amin is on the line in Ottawa. Hi, Amin.
Hey, good afternoon. My question for the guest is about Imperial Oil. What is his take? Thank you, and have a wonderful day.
Okay, just your take on Imperial Oil. A lot of energy questions today.
Yeah. I mean, Imperial's a good company backed by Exxon, but it's had a great run, right? So it's been really one of the big outperformers this year. There's one I like better, and I think you're going to see some relative trading to that effect. And it's going to be more oil exposed than the one that I would recommend. So we'll see on that.
With the price of oil where it is now, and with OPEC Plus, which we touched on earlier, why is Imperial enjoying this run-up?
Yeah, it's a good question. I think, certain stocks just have, there is a lot of relative performance trading, right? People are are benchmarked against certain benchmarks, and if that's the one that's working in the benchmark, people tend to coalesce around it. And if it's a big weight, then you can see it run. And to the contrary, and I'll talk about this in one of my other topics, with CNQ being the biggest weight in the energy index not performing, people go, well, all I have to do is not own that and own other things and I'll outperform, right? So in a short-term basis, in a flat oil price environment, which is what we've had kind of year to date, you might see some of that kind of, they're going to have a good quarter. I think it's just more short-term noise than it is necessarily long-term. If you have a longer-term chart, it's at the higher end of the range, but it's been pretty range-bound for quite some time.
Got it. Okay. Let's go back to the phone lines. We'll get to William, who is in London, Ontario. Hi, William.
Good afternoon. I've held Telus for a long time, and I'm losing money. Should I keep it or buy something else? And if I should buy something else, what would you recommend?
Okay, so telecommunication space, tough over the last number of years. All of the operators seem to be trying different things now to increase revenue. Do you like Telus in that space? Is there one you prefer more? Should he move out of telecommunications, period?
Yeah, we're not. I mean, certain things perform at different times, and we still like the in-place infrastructure that Canadian telecom companies have. I think Telus is well positioned alongside BCE and Rogers, frankly. I would counter the caller saying they're losing money. My guess is if you've held it for some time with the dividend, you're still doing just fine. It has come off the highs, but $30+ or whatever it was. But you're collecting a nice hefty dividend every year, and if you're not counting that, then you're not looking at the whole story. So I like the company long term. I've got another one of my top picks I think it's more timely right now. But Telus is really well positioned. They're ahead on their fiber build. They don't hold media assets, so they've got these other technology assets that are a bit of a wild card, but their core business looks pretty good. And it seems like Canadian wireless pricing is bottoming, or it's at least basing. So hopefully that's a better story for the sector going forward.
Got it. Let's get to Chris in Hamilton, Ontario. Chris, what's your question today?
For taking my call. I'd like to ask a question on Nutrien. I just wondered if with the world situation, what the future looks like for Nutrien.
Okay, thank you for the question. Nutrien, so potash has moved up from the April low and sort of steadied out after that, dropping more recently. What is your take on Nutrien?
Yeah, so there's a lot of, just like OPEC Plus with oil, there's a lot of geopolitical things happening here. You've got Russia and Belarus who are big producers, and the stock shot up to 130 on the invasion and has since come off. We sold some at those levels and still are holding kind of a half to 2/3 position and haven't sort of re-added to it. It's come all the way back down. We still like it on a long-term basis. You've also got BHP developing Jansen, but they're behind and potentially mothballing the second phase of it in Saskatchewan. That's BHP, the mining company out of Australia.
Mothballing why?
Just cost overruns, uncertain demand, things of that nature. So I like it here, frankly. It's got a nice dividend yield. It's a diversifier. We're not buying more of it at these levels, but for new clients that don't own any, we're happy to sort of take a partial position and see what happens. I think if you can get it under $70, that's where you'd like to see it.
Got it. Okay, we have to leave it there for questions. We're out of time for phone calls and emails, but Orion has new top picks. That's coming up after a break. Join us on Monday for Market Call. Bruce Campbell on the show. He's president and portfolio manager, Stone Castle Investment Management. He'll take your questions on Canadian stocks. That's on Monday. Time now to share Ryan's new top picks. We're going to start with something in the energy sector. Northland Power, NPI and the TSX. They do wind turbines. We had the CEO on yesterday, and they had a lack of wind, which led to a bad quarter for them. But you like this company moving forward. What do you like about Northland Power?
Yeah, and I, one thing I would push back on, even though I like the company, is this lack of wind doesn't seem to be necessarily reverting to the mean. That seems to be an ongoing issue. So I do have questions about that. But a bigger picture, they've got some larger projects. They just finished the battery storage project, Oneida in Ontario, ahead of time and under budget. This is what this company does, is they are good builders of projects. And they have 2 other projects ongoing. Taiwan, much maligned in the investment community, but has achieved first power. Turbines are being installed, on time and on budget. They are starting to install turbines in offshore Poland in the Baltic Sea project as well. So as those projects come on, there's a lot of cash flow. And the last time, the management team, which we didn't do a great job with that cash flow. We think that this management team is much better. So in the meantime, we collect 5.5–6%. Stock's down from yesterday, so it's even a better top pick today than it was before the earnings call. And I think you're clipping a nice yield to be patient while some very near-term and achievable catalysts are coming in the next sort of 2 to 3 years. Got it.
Okay, let's get to your next topic, which is BCE, which is the parent company of this channel under the Bell Media brand, which has had did an acquisition in the U.S. At the time it was announced, raised a lot of eyebrows. Has the investment community come around on the acquisition of Ziply, and what else is turning the stock around?
It would appear so. So, and this is where I want to give the viewers some perspective from where I sit, right? Which is not always viewable, by just reading newspapers or online information. So when something like this happens and the stock is wounded or hurt, because it's a larger weight in the benchmark, people will abandon it, right? Just simply by not owning it, you're outperforming on a short-term basis at least. And the telecom sector has been negative for a while, but that was there was already downward momentum. So you have quants that hate the name, meaning quantitative-based investors. Passive is going to be selling the name down as it retreats in the index. So you just have a wave of selling that comes along that is kind of, I don't know what the right word for it is. It feeds off itself, and it's structural. It's not necessarily rational in the moment. And so, we were looking at this going, hey, we don't like this acquisition either. We certainly do not like the dividend cut. We think management has a lot of questions to answer about this. We understood some of the reasons they were doing that, especially as it relates to how they've been regulated and putting some capital to work in a diversifying jurisdiction. And now, but because it came out so far to left field, the management team couldn't answer the questions ahead of time. It appears now they're going around and answering the questions. You don't get a stock like this, this big a company moving up this much without some serious institutional interest. And what I would say is, look at Manulife, look at AltaGas is another one we've experienced. When these big companies, especially if they're bigger weights in the index, once they start to turn and people get behind them and some of that predatory or quantitative-based selling subsides, they can move a long way. And so you're getting a nice yield while you kind of can ride that back up to, I'm not saying it's going back to $70 or anything like that, but can it get back to 40? Yeah, I think so.
Got it. And I should just ask for Northland Power and for BCE, do you guys own them?
Yes. We don't ever recommend anything we don't own.
Okay, let's get to your last recommendation, which is CNQ. We've got about under a minute, but we touched on it earlier, and you like it moving forward.
Yeah, not much to say here, other than that I haven't already said. Other than in a flat to questionable oil price environment, this has been the company that was the darling of the past few years, and now it's being sold on a relative trade versus, it appears, Imperial and probably Suncor and Cenovus too to some extent. I think you want to take advantage of that. You're getting almost a 6% dividend yield. This is the best operator in the business. Bigger exposure to natural gas. They did just ink their first natural gas contract off a US LNG project, which is interesting because their gas portfolio is pretty dormant. So we think you can do well by owning this company on a long-term basis.
Got it. CNQ. Ryan, I've got to leave it there. Thank you so much for joining us.
Thanks, Marilla.
Have a good weekend, and thank you for watching us here on Market Call. We'll see you again on Monday.